You know, people always ask me, Jim, should I rush to pay off all my debt once I hit 60? And every time I give them the same answer, absolutely not. In fact, paying off debt too quickly after 60 might be one of the worst financial moves you can make. I know that sounds shocking, maybe even a little uncomfortable. But stay with me, because once you understand the math, the psychology, and the opportunity behind this idea, you'll never look at your debt or your retirement strategy the same way again. When people hear me say that paying off debt after 60 isn't always smart, their first reaction is usually surprise, sometimes even disbelief. I get it. For decades, we've been told that being debt-free is the hallmark of responsible adulthood. At the moment you hit retirement age, your number one mission should be to eliminate every remaining balance you owe. But when you actually look at how wealth behaves, how money grows, and how financial security is built, you start to realize that rushing to pay off debt late in life can work again. Rather than for you, the truth is, paying off debt after 60 can weaken your financial foundation, because those years are when liquidity becomes more important than perfection. Your financial needs don't disappear as you age. In fact, they often become more unpredictable. Health expenses, lifestyle adjustments, family emergencies, market shifts, new opportunity to invest or travel or relocate, these things pop up, and they require cash on hand. When you wipe out your savings to eliminate debt, you may feel emotionally lighter, but financially you're more exposed. You've sacrificed flexibility to achieve a number on a statement that doesn't actually improve your day-to-day security. There's also this big misconception that debt is the enemy. People forget that debt is just a tool. Some tools are dangerous if misused, but in the right hands with the right understanding, they become powerful. After 60, the key is not to eliminate debt. It's to understand what kind of debt you have and what purpose it serves. If the debt is high interest and growing faster than your money can, that's one thing. But if you're dealing with low interest debt, especially something like a mortgage locked in at a rate lower than inflation or lower than what your money can earn elsewhere, then paying it off early is not the wise move. You're giving up potential returns for a psychological win, and that psychological win is what gets people in trouble. Emotionally, being debt-free feels clean and safe, but emotions don't compound. Money does. Safety isn't created by zero balances. It's created by strong cash reserve, diversified investments, and the ability to adapt to whatever comes next. When you're older, adaptability becomes a bigger part of financial survival. The world doesn't slow down for you. Markets don't slow down. Costs don't slow down. Your strategy can't slow down. Either another thing people don't consider is time horizon. Even after 60, you're not dealing with a short-term life. People are living into their 80s, 90s, even beyond. That's 2 or 3 more decades where your money needs to work. If you rush to pay off debt, you may feel like you are preparing for the next chapter, but what you're actually doing is reducing the growth potential of the years ahead. That money you used to pay off debt could have been invested. It could have been compounding quietly in the background, turning into a cushion, a safety net, or an opportunity fund. I've met countless people who regretted paying off debt too quickly because they felt good in the moment, but ended up cash poor a few years later. They had a paid-off house, but very little cash. They had no flexibility, no liquidity, and no way to take advantage of opportunities that came their way. They ended up borrowing again or selling investments they would have preferred to keep. They solved a problem that wasn't actually hurting them and created a problem that absolutely could. When you cross the age of 60, your decisions matter more because the room for error gets smaller. You don't want to lock away your resources. You don't want to trap your wealth in a place where it can't grow or help you. You want financial breathing room, the ability to respond, adjust, and move confidently. And that means keeping your money accessible, not racing to eliminate every debt. Just to feel like you did something responsible. The responsible move is the strategic move. And the strategic move is almost never the emotional one. Avoiding the rush to pay off debt after 60 isn't laziness or irresponsibility. It's smart financial positioning for the years that still lie ahead. Years where your money needs to be as flexible and powerful as possible. When I say that not all debt is dangerous after 60, people tend to raise an eyebrow. Debt has become one of those words that carries emotional weight, almost like a warning sign. But the truth is, debt isn't inherently good or bad. It's neutral. It becomes helpful or harmful depending entirely on how you use it and what kind of debt it actually is. After 60, understanding this difference becomes even more important, because the goal isn't to eliminate every balance you owe, but to understand which ones matter, which ones hurt you, and which ones can actually work in your favor for most of your life. You're taught to fear debt. You hear messages like debt means instability, debt is risky, debt steals your wealth, and if you're not careful, you start believing every form of debt is a ticking time bomb. But let me tell you something, some of the wealthiest people in the world, people who built fortunes, companies, careers, and investment empires, used debt strategically. They didn't run from it, they controlled it. They understood its cost, its timing, its leverage, and its purpose. And that's exactly how you should view debt. After 60, the problem is that fear-based thinking around debt pushes people into decisions that don't actually make them safer. They rush to pay off low-interest loans, they drain their savings accounts, they empty investment portfolios, and they box themselves into a corner, all because they were taught that carrying any debt in later life is irresponsible. But when you really look at it mathematically, that kind of blanket thinking just doesn't hold up. For example, if you have a loan at 3% interest and your money can reasonably grow at 5, 7, or even 10% over time, then paying off that loan early isn't smart. It's emotional. You've traded potential growth for the feeling of being debt-free and feeling. Don't build retirement security. The real danger isn't the debt. The real danger is misunderstanding the nature of the debt. High-interest debt, yes, that needs attention because it grows faster than your money can. But low-interest debt, that's just a tool. It's a financial lever that gives you the ability to keep cash available to invest, to build a cushion, or simply to create space in your financial life. Having strategic debt isn't a burden. It's part of a plan. It gives you breathing room, flexibility, and control, things that become more valuable as you age. And let's be honest, life after 60 isn't cheap. Healthcare, unexpected expenses, wants, needs, travel, home repairs, family situations, all of it requires money. And not someday now. When you choose to eliminate debt at the cost of your liquidity, you're putting yourself at risk. You're reducing your options. I've seen too many people pay off their mortgage because they wanted the emotional piece of zero debt, only to realize later that they didn't have enough cash to handle emergencies or opportunities. And here's the irony. They ended up taking on new debt later, often at worse terms, because their decision wasn't strategic. It was just emotional. That's why I say not all debt is dangerous. Some debt is actually stabilizing. It keeps your cash in your hands. It allows you to invest, grow, and prepare. It lets you preserve your wealth instead of locking it away in something that doesn't generate returns. When you're younger, the conversation around debt is different because you have many working years ahead to recover from mistakes. But after 60, the smartest approach is to treat debt as a component of your larger strategy, not as a villain you're trying to eliminate at all costs. If the debt has a low interest rate, if the payments are manageable, and if eliminating it requires sacrificing liquidity or disrupting your investment growth, then that debt isn't hurting you. It's helping you. It's protecting your capital. It's giving you time. It's allowing your money to do what money is meant to do, work, grow, and support. Your future debt is only dangerous when it grows faster than your wealth. Debt is only dangerous when you misunderstand its role. But when you understand it, when you use it strategically, and when you make decisions based on math rather than fear, debt becomes a tool that can actually strengthen your financial position instead of weakening it. People often assume that saving is the safest, most responsible financial move you can make, especially after 60. And sure, saving has its place, but saving alone is never enough, and it becomes especially limiting as you get older. People think saving equals security, but in reality, saving without a strategy can quietly erode your financial power. It feels safe because you see the numbers sitting in your account, but money that sits still doesn't grow. It doesn't protect you from inflation. It doesn't expand your options, and it doesn't build the kind of financial cushion you truly need later in life. After 60, strategy matters far more than saving for the sake of saving. You have to understand that the world you grew up in is not the world you retire in. Years ago, saving alone might have gotten you somewhere. Interest rates were different. Costs were different. Life expectancy was different. But today, living 20 to 30 years after retirement is common. That means your money has to last longer, work harder, and move smarter. Saving can't do that by itself. If your money sits in a traditional savings account or under a mattress or tied up in a place where it earns almost nothing, you're falling behind every day. Not because you're making bad choices, but because the cost of living climb faster than your savings do. This is where strategic growth comes in. You don't need to take wild risks or bet your future on predictable moves. But you do need to make sure your capital is positioned to grow. That could mean investing in conservative, steady assets. It could mean keeping money in accounts that compound. It could mean maintaining a portfolio that's designed for long-term, consistent growth rather than short-term excitement. The point is simple. Your money has to be active. Wealth is built by movement, not by stagnation. A lot of people confuse saving with safety. They say, I don't want to risk losing money, so I'll just keep it in savings. But the danger isn't losing money on an investment. The real danger is losing purchasing power. The danger is keeping your money still while the world moves forward without you. When your money doesn't grow, you lose ground quietly. You don't feel it day to day, but you feel it later when expenses rise, emergencies hit, or opportunities appear that you can't take advantage of because you play everything too safe, and after 60, the stakes get higher. You need stability, yes, but you also need your money to outpace the forces working against it. Inflation doesn't stop because you reach retirement age. Medical costs don't pause. Life doesn't slow down. If anything, life becomes more unpredictable, which means your financial approach needs to be stronger than ever. Saving without strategy is like parking your car in a garage and hoping it takes you somewhere it won't. Movement requires intention, and money needs direction even emotionally. Relying on saving alone can create anxiety. People feel a sense of fear watching their savings decrease over time, especially in retirement. But when your money is growing, even slowly and steadily, you feel empowered. You feel like you have momentum, like your future is still expanding instead of shrinking. That's the difference between simply saving and using strategy. Strategy builds confidence. Strategy creates freedom. Strategy gives you control rather than leaving you hoping you're saving. We'll stretch far enough. I've met people who save diligently their whole lives, only to realize after 60 that savings alone couldn't carry them through the next 25 years. They had the discipline, but not the strategy. Then I've met people with fewer savings but smarter positioning. They invested wisely, stayed diversified, kept their money active, and ended up far more financially secured in the long run. The lesson is the same every time. Saving is a tool, not a plan. A pile of cash won't protect you from the future unless that cash is worked. After 60, you don't need to chase big wins or risky returns. You simply need a strategy that lets your money grow steadily, predictably, and consistently. Saving alone can't do that. A smart financial plan can. And once you understand that, you stop thinking in terms of simply saving and start thinking in terms of building, maintaining, and expanding your financial strength through strategic, intentional action. One of the biggest misunderstandings I see as people get older is the idea that debt should be treated as a burden no matter what. They think the responsible thing is to eliminate all debt as fast as they can, especially after 60. But what most don't realize is that not all debt is the same. Some debt is harmful, sure. High-interest credit cards, predatory loans, anything eating away at your income with nothing to show for it, that's the kind of debt that drains you. But there's another category of debt that can actually work in your favor, even later in life. When you understand the difference between harmful debt and strategic debt, your entire perspective on money changes. People often lump every loan, every balance, every payment into one bucket called bad debt, and they panic. They feel pressure to clear it all out the moment they approach retirement, even if doing so strips away their liquidity or forces them to use money that could be growing for them. But the truth is, debt tied to an appreciating asset can often be a tool rather than a problem. A mortgage on a home that continues to increase in value is not the same as owing money on a credit card. A low-interest loan that frees up capital for investing is not the same as a loan that traps you in high fees. When debt is attached to something that grows, or when it gives you leverage that multiplies your money elsewhere, it's not the enemy. People assume it is. I've always viewed money as something that should be evaluated based on movement, purpose, and potential. A dollar is not just a dollar. The way that dollar works for you is what matters. If paying off a certain debt would take your cash and lock it away where it earns nothing while keeping the debt give you liquidity and the ability to grow at a higher rate, then paying it off becomes a loss disguised as responsibility. People have been conditioned to believe that being debt-free is the ultimate financial goal. But in many cases, being strategic is far more valuable than being debt-free. Smart debt can keep your capital available, working, compounding, and expanding your options rather than shrinking them. I've met people who felt guilty for not rushing to pay off a low-interest mortgage after retirement. They thought they were doing something wrong. Meanwhile, they were sitting on cash that could have been invested in steady, compounding assets. That cash could have easily outperformed the cost of the loan. But because they saw debt as a moral problem instead of a financial tool, they missed opportunities. The emotional side of debt is powerful. It can make you feel exposed or uneasy. But once you detach from the emotional weight and start looking at debt from a mathematical perspective, the picture becomes much clearer. Numbers don't panic. Numbers don't carry guilt. Numbers just reflect reality. The key is understanding which debts amplify your financial position and which ones drain it. High-interest credit card balances will always be harmful because they take more from you than they give. But a fixed-rate mortgage at a low percentage while your home's value increases every year is a completely different story. A loan that allows you to keep more of your cash invested, earning returns that exceed the cost of borrowing, can actually strengthen your financial position. People say they want freedom from debt, but there's another kind of freedom. That's often overlooked, the freedom that comes from liquidity and growth. When you hold on to your cash instead of tying it up in the walls of your house or the payoff of a low-interest loan, you give yourself flexibility. You give yourself breathing room. You give yourself the ability to respond to unexpected opportunities or challenge. Without scrambling after 60, that flexibility becomes essential. Life becomes less predictable, not more. Medical expenses, family needs, market conditions, housing decisions, everything becomes a series of moving pieces rather than a fixed plan. Strategic debt gives you the cushion to shift when life demands it. Paying off everything blindly can leave you with a beautiful sense of moral satisfaction but very little financial protection. The people who thrive in retirement aren't the ones who eliminated every debt at all costs. They're the ones who understood which debts didn't hurt them and used their resources in ways that kept them growing instead of shrinking. Not all debt is harmful. Some of it can be one of the strongest tools you have. If you handle it with intelligence and purpose, the goal isn't zero debt. The goal is smart debt, smart cash flow, and a smart strategy that keeps you moving forward instead of locking you in place. Something interesting happens when people hit 60 or get close to retirement age. They start thinking about their money in terms of safety instead of opportunity. And while safety matters, the shift often becomes too extreme. People begin making decisions based on fear rather than logic. One of the biggest examples of this is liquidity. Liquidity means having money available when you need it. Money that isn't locked away, money that gives you choices. But a lot of people trade their liquidity for the emotional comfort of being debt-free. They drain their savings, cash out investments, and empty emergency funds just to see a zero balance on a loan statement. It feels good emotionally, but financially, it can be one of the most limiting choices you can make after 60. I've always said that money you can use is more valuable than money that is sitting still behind a locked door. When you pour all your cash into paying off a low-interest debt, especially later in life, what you're really doing is turning flexible, accessible money into frozen, inactive money. You turn cash, which can be invested, spent strategically, saved for emergencies, into something that has no movement and no multiplier. Paying off debt gives you psychological relief, sure, but it doesn't give your money room to grow. And after 60, growth is still incredibly important. People think growth is something you chase in your 30s or 40s, but as long as you're alive, your money needs to keep pace with inflation, healthcare costs, and unexpected life shifts. This is why I say liquidity matters more than zero balances. Liquidity is your buffer. It's the thing that keeps you from panic. It's the thing that prevents you from selling investments at the wrong time or dipping into retirement accounts with penalties or borrowing again at a higher rate. Liquidity gives you breathing room. When you have accessible cash, you're not stressed when the car breaks down, when a medical bill arrives, or when the markets get shaky. But if you tie your cash up paying off debt just to say you're debt-free, now you might be house-rich and cash-poor. And being house-rich and cash-poor is not freedom, it's not security, it's not peace. It's a trap dressed up like accomplishment. I've watched people in their 60s and 70s panic because they paid off their mortgage too aggressively, only to realize that they no longer had enough liquidity to handle normal life events. They thought eliminating debt was the responsible move. But responsible doesn't mean draining yourself. Responsible means positioning yourself to handle whatever comes with as little financial strain as possible. Liquidity lets you do that. When you keep your cash accessible and put it somewhere it can grow at a steady, reliable rate, your financial foundation becomes stronger, not weaker. Meanwhile, low-interest debt continues quietly in the background, manageable. And predictable people underestimate the value of fixed. Low-interest payment is something you can plan for. What you can't always plan for is your health, your family's needs, the market, or major surprises. Liquidity fills in the gaps that life creates. It smooths out the rough edges. It makes the unexpected feel manageable instead of devastating. It gives you control at a time in your life when so much can feel uncertain. There's also the matter of opportunity. When you have liquidity, you're ready when a good investment presents itself. You can say yes, instead of wishing you had the funds available. Whether it's a safe, income-producing investment, a market dip, or a tax advantage move, opportunities don't wait for you to rebuild your savings after paying off your mortgage. They pass by quickly. Liquidity keeps you ready. So many people think the goal after 60 is to eliminate everything that looks like a liability. But the real goal is to maximize your flexibility. Debt is not the enemy if it's affordable, predictable, and tied to something stable. Lack of liquidity is the real enemy. Lack of liquidity is what causes people to panic, to make desperate decisions, to compromise their retirement, and to lose control. Liquidity is freedom. Liquidity is power. Liquidity gives you choice. And at this stage in life, choice is the most valuable asset you can protect as people get older, especially once they cross 60. There is this idea floating around that the safest, smartest move is to reduce everything down to zero debt, zero obligations, zero risks. But what many don't realize is that when you chase the feeling of zero, you sometimes sacrifice something much more valuable, control. And control, especially when it comes to your finances, doesn't come from having every balance paid off. Control comes from having access to capital. It comes from liquidity, from flexibility, from being able to make decisions without feeling boxed in by your own choices. People often say they want financial peace, they want stability, they want to stop worrying. But those things don't come from sending every dollar you have toward a mortgage or a loan. They come from knowing you have money on hand, money you can use today, tomorrow, or whenever you need it. Money that isn't tied up in a house or locked inside an asset you can't tap without paying a penalty or taking on new debt. When you keep your capital accessible, you become the one in control. You're not reacting to life, you're directing it. I've always found it interesting how people assume being debt-free is synonymous with being secure. But I've seen just as many people who are debt-free and stressed out, people who carry small, manageable debt but have healthy liquidity. If someone has no mortgage, no loans, but only a few $1,000s in the bank, that person is far more vulnerable than someone with a low-rate mortgage and a strong cushion of cash or investments. Vulnerability doesn't come from debt alone. It comes from lack of options. And liquidity is what gives you options. For example, let's say someone pays off their home using most of their savings. Emotionally, it feels fantastic. They celebrate. They feel light, accomplished, responsible. But then 6 months later, a medical bill hits, their roof leaks, or the markets take a turn, and they need cash suddenly. Now what? They're stuck. Their money is trapped inside the walls of their home. In order to get it out, they'd need to refinance, sell the house, or take on new debt, usually at a much worse rate than before. They traded control for a moment of emotional relief. That's not a good trade. I've always believed that financial security is less about what you owe and more about what you can access. Accessible money gives you the power to say yes or no on your own terms. It lets you handle emergencies gracefully. It keeps you from making desperate decisions. It protects your investments because you don't have to pull from them at the wrong time. It gives you mental clarity because you know you're prepared. That kind of control is worth far more than the symbolic victory of eliminating every debt payment. And here's the thing about life after 60, it's unpredictable. No matter how well you plan, there are variables you can't see coming. Health, family needs, economic changes, interest rates, tax changes, inflation, everything moves, everything shifts. So the question isn't how do I eliminate everything? The question is how do I stay adaptable? Flexibility beats rigidity every time, especially in later years. And adaptability comes from having resources you can use at a moment's notice. When you have access to capital, opportunities also become easier to take advantage of. Maybe a solid investment comes along, one that's lower risk and generates consistent income. Maybe the market dips and you want to buy in. Maybe you want to downsize or relocate or help a family member. If your money is locked away, you can't move. You can't act. You can't capitalize on timing. But with liquidity, you get to choose how and When you move, people often forget that the point of money isn't just safety, it's control, it's freedom, it's choice. Those are the things that make retirement enjoyable, not the absence of every payment. A low-interest mortgage or strategic debt doesn't take away your control. Lack of accessible money does. When you think of it this way, you start to realize that the strongest financial position isn't the one with the fewest debts, but the one with the most options. And options come from liquidity, not from chasing a zero balance on paper. One of the most overlooked truths about life after 60 is that the landscape changes in ways you can't fully predict. You can plan, you can prepare, you can run every calculator and follow every guideline, but the reality is that the next chapter isn't fixed. It moves, it bends, it surprises you. And that's exactly why optionality becomes more valuable than almost anything else at this stage of life. Optionality simply means having choices. It means having the ability to pivot, adjust, react, or seize opportunities as they arise. And the reason I emphasize optionality so much is because most people unknowingly eliminate their own options by rushing to pay off every debt they have. They think they're buying safety, but what they're actually giving up is flexibility. And flexibility is what keeps you financially healthy later in life. When you're younger, you can recover from mistakes with time. But after 60, time isn't your main resource anymore. Your main resource is the freedom to make the right move when life shifts. That freedom comes from having liquid money, accessible credit, strong investments, or cash reserves, not from having a perfectly clean debt slate. Debt isn't the enemy. Rigidity is after 60. Your financial world becomes a series of unexpected moments. Your health might change. Your family situation might shift. You might want to move closer to your kids or downsize. The market might present an opportunity you didn't expect. A sudden expense might show up that you didn't plan for. And those are the moments where optionality makes the difference between stress and confidence. When you keep all your money accessible and refuse to lock it up in places where you can't touch it, you create breathing room. You give yourself the ability to choose the smartest response instead of being forced into the only option available. Think about someone who wipes out their savings to pay off a mortgage at 62. On paper, it looks responsible. The mortgage is gone. The house is free. But now they have very little cash left. And what happens if they need money for a health issue, or want to help a family member, or want to take advantage of a really good investment? Their money is trapped. They eliminated a payment, but they also eliminated their ability to move. Their home is paid off, but they can't turn those bricks back into dollars without taking on new debt or selling the property. That's a loss of optionality, and that loss is far more dangerous than carrying a manageable mortgage payment. Optionality is not just financial, it's psychological too. Knowing you can act gives you confidence. Knowing you have choices makes everything feel lighter. It changes the way you think, the way you plan, the way you respond to uncertainty. After 60, uncertainty doesn't disappear, it shows up more often. And optionality is the antidote to uncertainty. A person with options is calm. A person without options is anxious, even if they're technically debt-free. I've seen it over and over again. The interesting thing is that people think the biggest risk after 60 is carrying debt. But the bigger risk is not being able to adapt. Markets change. Interest rates change. Medical advancements change. Tax laws change. Your needs change. Your goals change. Optionality lets you adjust without financial strain. You can refinance if it makes sense. You can move if you want to. You can shift your investments. You can handle emergencies without blowing up your retirement plan. You can decide things on your own terms instead of reacting under pressure. Optionality also protects you from making emotional decisions. When you have liquidity and flexibility, you don't have to sell investments at the wrong time. You don't have to withdraw from retirement accounts when the market is down. You don't have to go back into debt with higher rates because you paid everything off too aggressively earlier. Optionality keeps you measured. It keeps you rational. It keeps you prepared. The whole purpose of building wealth is to create a life defined by choice, not necessity. And that becomes even more important with age. When you maintain optionality, you maintain the ability to shape your future instead of having it dictated to you. That's why after 60, the smartest move isn't eliminating every debt. It's protecting your options, keeping your money accessible, and allowing yourself the flexibility to live the next chapter on your own terms. When most people think about life after 60, they think about preservation. They think about cutting risks, slowing down, and protecting what they have. And while preservation is important, it's only half the story. The other half, the part most people overlook, is growth. Financial and personal growth don't stop when you retire or hit a milestone age. In fact, they become even more important because the years ahead can be long, dynamic, and full of opportunity if you approach them correctly. One of the key mistakes I see is that people separate personal growth from financial growth as if one doesn't affect the other. But the reality is that they are deeply connected, especially after 60. Think about it this way: when you continue to develop your knowledge, your skills, your mindset, and your perspective, you also improve your ability to make smart financial decisions. A person who reads, learns, and adapts is better equipped to navigate market shifts, identify opportunities, and manage risk. That same growth influences personal decisions too, whether it's choosing how to spend your time, how to engage with your family, or how to pursue meaningful experiences. The ability to learn and adapt keeps you sharp, confident, and flexible. Growth in one area compounds in the other, creating a cycle of improvement that lasts far beyond what most people anticipate. After 60, this connection between personal and financial growth is critical because the stakes are higher. You're not just thinking about today or next year, you're planning for decades ahead. Markets fluctuate. Health circumstances change. Unexpected expenses arise. Having the ability to make informed, thoughtful decisions requires continuous learning and growth. If you stop developing yourself, you slow down your capacity to respond. You lose the edge that allows you to see opportunities where others see obstacles, to make decisions with confidence rather than fear, and to maintain a sense of control over your life and money. One of the reasons growth matters so much is that it keeps you engaged mentally and emotionally. People often assume retirement is a time to relax completely, but mental stagnation can be dangerous. When you stop challenging yourself, stop exploring, stop learning, your mind loses sharpness. That affects financial judgment, problem solving, and the ability to manage complexity. It also affects personal satisfaction. Growth keeps you curious. Growth keeps you adaptive. Growth keeps life interesting and fulfilling. And when life is interesting, your financial decisions are better because you're thinking clearly, strategically, and proactively instead of reacting out of fear. The other side of this is that financial growth also feeds personal growth. When your money is working intelligently, when your assets are growing, you gain confidence and freedom. That confidence allows you to take risks in personal projects, pursue passions, or invest in experiences that matter to you. It reduces stress because you're not constantly worried about cash flow or unexpected bills. It gives you leverage over your circumstances because you can act decisively when an opportunity arises. Personal and financial growth feed each other, and when you understand that, it changes the way you approach life after 60. Another important element is that growth allows you to leave a legacy while still enjoying the present. People think that saving and hoarding are enough, but growth, both personal and financial, ensures that you can make meaningful contributions, help family, or even support causes you care about. It's not just about accumulation, it's about impact. The money you grow and the wisdom you gain multiply over time, not just for you, but for the people around you. The key takeaway is that growth doesn't stop at a certain age. Your mindset, skills, knowledge, and financial acumen can continue to develop, and when they do, you gain both security and opportunity. After 60, it's easy to fall into the trap of thinking that slowing down is safe. But true safety comes from staying engaged, staying adaptable, and keeping both your mind and your money active. When you continue growing personally, you make better financial decisions. When you continue growing financially, you create more opportunities in life. The two are inseparable, and the smarter you become at leveraging both, the stronger, free, and more fulfilling your later years will be. One of the most important lessons I've learned over the years, especially after spending decades in finance and investing, is that following societal norms blindly is one of the fastest ways to limit yourself. People often assume that once you hit 60, or even earlier, you should follow the script society has laid out for you. Retire at a certain age, pay off every debt, live a slow and quiet life, and just enjoy the years left. On the surface, it sounds responsible. It sounds safe. But the reality is, most societal norms are outdated. They were created for a different world, with different lifespans, different economic opportunities, and different expectations. Clinging to them can actually keep you from achieving the financial security, flexibility, and growth you deserve after 60. The consequences of following the norm blindly become more pronounced. Many people rush to pay off all debts, liquidate investments, or avoid opportunity they perceive as risky simply because that's what people do. But risk is contextual. What looks risky in a vacuum might be an incredible opportunity when viewed strategically. Societal norms are based on averages, not individual situations. They're designed to simplify decisions for the masses, not to optimize outcomes for someone with decades of experience, knowledge, and resources at their disposal. Treating norms as rules can prevent you from making smart moves that actually enhance your wealth and freedom. The truth is, some of the most successful investors and financial thinkers have ignored conventional advice when it didn't make sense. They didn't follow the herd. They questioned assumptions, challenged accepted wisdom, and made decisions based on data, strategy, and long-term potential. And that's exactly the mindset you need after 60. You're no longer working to prove yourself. You're not trying to follow a checklist. You're making choices based on your own life, your own goals, and your own circumstances. That freedom to challenge norms is a huge advantage if you use it wisely. One of the most common examples is debt management. Society tells us to be debt-free by a certain age. But as I've said many times, paying off low-interest manageable debt after 60 can sometimes reduce flexibility rather than increase it. Society would say it's the responsible choice. Strategy tells you to keep your options open, maintain liquidity, and let your money grow. Following norms without thinking critically can cost you far more in opportunity and control than the emotional satisfaction of being debt-free. It's the same with investments, lifestyle, and timing decisions. People often follow conventional retirement advice, sell investments, move to cash, live conservatively. But markets, opportunities, and personal circumstances change. Sticking rigidly to norms can leave you stagnant, while challenging those norms allows you to adapt, respond, and capitalize on what the world actually offers rather than what someone decided was appropriate for your age. Flexibility and adaptability are built on questioning conventional thinking. Challenging norms also protects your mindset. It keeps you sharp, engaged, and curious. If you follow every societal expectation without questioning it, you become passive. You stop learning. You stop evaluating new information critically. That passivity can hurt both your personal life and your financial life. By questioning norms, you remain active, involved, and thoughtful in your decisions. You maintain control over your life rather than surrendering to rules that were never designed. For your individual situation after 60, the stakes are higher, but so are the opportunities. You have decades of experience, knowledge, and perspective. You've seen trends, patterns, successes, and failures. You have a unique advantage if you're willing to challenge the conventional thinking that says you should slow down, pay off everything, and just coast. By rejecting outdated norms, you can create more flexibility, more growth, and more control than most people ever realize. Life doesn't end at 60. The rules society set up for retirement were never meant to define your potential. Ultimately, challenging societal norms is about ownership. It's about taking responsibility for your choices, not blindly following instruction. It's about leveraging your experience, your resources, and your freedom to make decisions that truly reflect your goals. When you reject the idea that you have to follow the herd, you unlock possibilities that others never even consider. You begin to see that your best years financially, personally, and mentally can be some of the most dynamic of your life, precisely because you're willing to question the status quo and make smart decisions on your own terms. When people talk about retirement, they often treat it as the finish line, the moment when the hard work ends and life slows down. But I've learned over decades in investing and in life that retirement isn't the end of growth, opportunity, or contribution. It's actually a new beginning, the way most people see it. After 65, you're supposed to take it easy, stop taking financial risks, and simply manage what you've already built. But that mindset is limiting. If you look at retirement as a launchpad instead of a finish line, your perspective and your result change dramatically. The first thing to understand is that you have decades ahead of you. People are living longer, healthier, and more active lives than ever before. That means you have time to make strategic decisions, grow your assets, even take calculated risks that can improve your financial position and your lifestyle. Viewing retirement as a finish line ignores that potential. You've spent your life learning, building, and growing, and the skills, knowledge, and capital you've accumulated don't have to stop being useful. In fact, they can become even more powerful if you apply them strategically. In this next chapter, a new beginning also changes how you approach money. Many people see retirement as a period of conservation. Spend cautiously, avoid risks, and protect every dollar. But when you think of retirement as a new beginning, your perspective shifts. Now, every decision becomes an opportunity to leverage your experience. Low-interest debt, investments, strategic allocation of capital, all of these can work in your favor if you're intentional. You stop treating money as a static safety net and start treating it as a tool that continues to work for you, providing flexibility, options, and even growth well into your later years. Personal growth doesn't stop either. Just as your money can continue to grow, so can your mind, your skills, and your influence. Retirement as a new beginning is about more than financial strategy. It's about engagement, learning new things, exploring new opportunities, and applying your experience to fresh challenges. Keeps your brain active, your judgment sharp, and your confidence high. That intellectual and emotional growth directly affects your financial decisions. When you remain curious, adaptable, and alert, you're far better positioned to respond to market shifts, lifestyle changes, and unexpected events. And another key aspect is that seeing retirement as a new beginning allows you to redefine success. Most people define retirement success in terms of comfort or security, but if you approach it as a launch pad, success becomes about opportunity, impact, and fulfillment. You can focus on projects, investments, or experiences that align with your goals rather than what society dictates is appropriate for someone your age. You stop thinking about slowing down and start thinking about leveling up in areas that matter to you, whether that's your finances, your personal life, or the legacy you want to leave. The psychological shift is enormous. People who see retirement as an endpoint often become risk-averse, passive, and disengaged. But when you see it as a new beginning, you stay proactive, alert, and purposeful. Every decision is framed around action rather than reaction. You maintain control because you recognize that life after 65 is not about waiting. It's about applying your knowledge, resources, and energy to make the next chapter as strong and dynamic. The previous ones, financially, treating retirement as a new beginning also changes the way you manage resources. Rather than just preserving your nest egg, you look for ways to grow it intelligently. Compounding doesn't stop at retirement, and neither should your strategic thinking. You can take advantage of opportunities that others ignore because they assume the game is over. You can continue to build assets, invest wisely, and position yourself for continued financial stability. Optionality. Ultimately, the idea of retirement as a new beginning is about freedom, control, and potential. It's about taking everything you've learned, everything you've built, and applying it in ways that continue to benefit you and those around you. It's about using your experience, your money, and your time intentionally. The best part is that by thinking this way, you see that age is not a limit, it's an asset. Experience is leverage. An opportunity is still waiting. The choices you make now can set the stage for some of the most impactful, rewarding, and exciting years of your life, far beyond what most people imagine. So let's take a moment and really think about what we've been talking about here. When you hit 60, society loves to feed you a script. Pay off all your debt. Retire, slow down, save every penny. Don't take risks. It's comforting advice in a way because it feels responsible and safe. It gives people a sense of control over something that otherwise feels unpredictable. Aging, changing health, markets, family needs, and the sheer uncertainty of what comes next. But the reality is that following this script, blindly believing that debt equals security, can actually put you in a weaker position. It can leave you less flexible, less in control, and frankly, less able to take advantage of opportunities that life will inevitably throw your way. And here's the point I really want to make. After 60, your financial game is no longer just about surviving or avoiding risk. It's about strategically leveraging everything you have, your money, your knowledge, your experience, to keep moving, keep growing, and keep creating options for yourself. Many people think that debt itself is the enemy. They hear the word and their heart races. They imagine a burden they must escape from, as if eliminating it will suddenly make everything in life simpler. But as we've talked about, debt is a tool. Some debt is dangerous, of course, credit cards with sky-high interest rates, predatory loans, but low interest, manageable debt can actually enhance your flexibility. It keeps your cash accessible, gives you the ability to invest, and allows your money to continue working for you rather than sitting frozen in a mortgage or some large lump sum payment. The emotional satisfaction of being debt-free is real, yes, but it doesn't grow your money, it does protect you from surprises. And it doesn't give you the freedom to pivot when circumstances change. Real security comes from having choices, and choices come from liquidity, optionality, and strategy, not from zero balances on paper. Liquidity in particular is something most people underestimate. After 60, life is full of surprises. Medical bills arrive, home repairs appear out of nowhere, travel or family obligations pop up, and sometimes unique investment opportunities appear that you never expected. If all of your cash is locked up because you aggressively paid off your mortgage or drained your savings to eliminate a loan, suddenly those opportunities become impossible to see as you're forced to react, not act. You lose control, and losing control is far more stressful and far more dangerous than carrying a small, manageable debt that is strategically positioned. Money that is accessible is money that empowers you. It's not just about numbers, it's about the freedom to make decisions that align with your life and your goals. And let's not forget that life after 60 is long. People live into their 80s, 90s, even beyond. That means your money needs to work even in retirement. Sitting still is not enough. Inflation continues, healthcare costs rise, and opportunities come and go. A low-interest loan might seem like a burden to pay off, but if your capital can grow at a high rate elsewhere, paying it off early is a trade-off that actually costs you potential growth. Strategic thinking about debt and liquidity is what allows you to preserve your lifestyle, maintain optionality, and keep your financial foundation strong, no matter what comes next. There's also the psychological side of this. People often assume that being debt-free will give them peace of mind, and in the short term, it might. But in the long term, peace of mind comes from knowing you have control, not from a zero balance. Peace of mind comes from knowing you can respond to emergencies, take advantage of opportunity, and maintain the life you want to live, no matter what unexpected challenges arise. Debt itself rarely causes stress when it's manageable. What causes stress is rigidity, the inability to move, to adapt, to make choices when circumstances shift. Flexibility and liquidity, not the absence of debt, are what bring real confidence. Optionality is another piece of this puzzle. As you age, your ability to adapt becomes one of your most valuable assets. Optionality is about having choices, not being locked.